Hi, this is Gigi of the Boring Trader website. This is a video about the 15 minutes breakout system, and in particular on the week number 6 from the 4th to the 8th of May. Usual warning and usual caveats. This week was quite bad, and it's important to get used to bad weeks because there will be quite a few, however good your system and your discipline in following it is. It is particularly interesting to show some concept of what it means to rely on statistics. This week I will talk a bit about this. So first of all, forget about that positive number 3.2R, 3.2R or 2.7R. The hit ratio was so low this week that the impact of commissions was basically 100%. Whatever little progress you would have been would have been eaten by fees. And remember, this is the result of the system as it should have been traded. If you had all the chaos of distractions, mistakes, and whatever else, you would most definitely have had a loss this week. But there is more to see and learn from weeks like this. If you have followed closely, you would see that this chart of the week performance is basically exactly the opposite of many of the charts we had so far. Higher in the middle and losing down in the end. These were the charts we were used to. We don't start very well. Middle of the week is kind of iffy, but at the end of the week, really the system takes on. We had several weeks like this. Now, if you compare this with the this week equity, you see that it's basically the opposite. So this week was not in line with the other weeks, and it's good to see these weeks. And first of all, we have some reassurance that we are not overfitting our parameters. It was a little bit too good to be true so far. But what are statistics doing? The statistics are telling you what happened in the past so that you can take more informed decision for the future. But the future can be very different from the past. Sometimes it's the opposite. To give you an example, you might remember that last week we saw how trading between 9 and 10 in the morning for the past 5 weeks would have been really bad. You would have had a loss of 7R. So that I was considering, just as an example, to not trade between 9 and 10. Well, this week, if you didn't take the trades between 9 and 10, you would have missed 6R. So a big chunk of this week. It was by far the best performer of the time of the day rank. Exactly the opposite. Another example, you might remember that US dollar against the yen and gold have been the best performers so far. This week they were totally flat. You might remember that the weakest links on the system so far were the euro and against the dollar and the dollar against Canadian dollar. Well, this week they were number 1 and 2, although obviously with lower score. And I can go on, but I would just like to highlight that there are some lessons to be learned from this. To start with, 5 weeks and about 700 trades sound a lot, but they're not a very big sample. In statistical terms, they're not very meaningful. You need much more, many more numbers. The other big thing is that focusing on some parameters, some markets, some filters, or time of the day, may not be a good idea yet, because the sample is still small. And it's vital that even if you don't use them, all of this for trading, and you are just picking some specific instruments or some specific time of the day, it's important that you keep testing and journal all of them all the time, because you never know what the future is going to give you. And it might well be that if you don't trade at 9 o'clock anymore, and this week is going to be reproduced for 3-4 other weeks, you are basically losing out. And it's also quite important to see that reducing the number of trades, reducing the number of instruments, or reducing the number of filters, or whatever it is, it's a little bit counterproductive, because you're always going to lose, or at least most of the time, you're going to lose diversification. And diversification is really what keeps you afloat in these circumstances. Another example is a trader was telling me that the filters were not really working properly, and they didn't add or subtract anything, and so why don't we keep things simple and don't use the filters, which is a very good point. I love to keep things as easy as possible. But this week, for instance, your trend following filters will have saved you 6R losses, which is massive. Another point I would like to make here is that there are some advantages in being your own trader and being self-employed, and you don't have anybody to answer to. You decide what to do and not to do. You always have the choice of not playing, which is the biggest choice we have. Staying out of the market. With this in mind, think about Friday the 8th of May. It is a UK bank holiday, although the other markets were open. Lagarde was speaking in the middle of the day after some tricky German court ruling that may or may not have a pretty big impact on euro. It was a non-farm payroll day. I mean, what do you expect? There's going to be quite a lot of uncertainty, no volatility whatsoever, until the volatility explodes in one bar if Lagarde says something stupid, or if the non-farm payroll was something that nobody expected. So stay out. It wasn't a good day from the beginning to trade. This is the cumulative trade management comparison, and as you can see, the results of last week were a drawdown. Still, really, I really love this curve. It's working particularly well. I wasn't expecting it to work so well for so long. I would have expected these to happen a little bit earlier. But they do happen, and there's quite a lot to say about drawdown. I won't really dwell here on drawdown topics, but I would say that a retracement of the yield curve was to be expected. And also the warning here is, don't expect that your worst drawdown has happened yet. There is always a new one, bigger one, behind the corner, and you have to live with that. Okay, it's long video already, so I will stop here, but you know where to find me. Stay alert. Bye.